I want to walk you through what's really unfolding right now in the silver market, because beneath the surface of price moves and daily headlines, something far more structural is taking shape, and it's not being widely understood. As we moved into the weekend, the amount of silver officially designated and ready for delivery inside the futures system remained parked at just over 88 million ounces. On paper, that stability might look harmless. No dramatic drop, no visible panic. But the real signal wasn't in what moved, it was in what didn't. Nothing new came in. That matters more than most people realize. At the same time, the broader category of silver sitting in vaults but not immediately available for delivery quietly shrank again, with another noticeable chunk exiting in a single session. So even though the headline deliverable number didn't fall, the total pool of metal in the system is still draining. Now here's where the math starts to tell a story. Open interest tied to the upcoming contract cycle still represents roughly 222 million ounces of silver. Compare that to the 88 million ounces actually ready for delivery, and you're staring at a gap of well over 130 million ounces between theoretical obligations and available supply. Normally, that tension gets resolved through something called the roll, where traders shift positions forward into future contracts instead of taking delivery. But the pace of that shift has been unusually slow. Only a small portion moved in a full day of trading, and with just a handful of sessions left before settlement begins, the timeline is getting tight. When obligations are large and time is short, markets don't get the luxury of smooth adjustments. That's when pressure builds. Now let's add another layer, because the global backdrop makes this even more interesting. All week long, one of the largest engines of physical precious metals demand in the world was essentially offline due to holiday closures. Conventional wisdom would suggest that without that participation, metals should drift or weaken. Instead, silver surged sharply into the end of the week. Gold strengthened too. Both did it without help from one of their biggest buyers. So the obvious question becomes, what happens when that demand engine comes back online? Even before trading fully resumes there, physical buying interest inside that market was already showing signs of strength. In fact, bids for ultra-pure silver were being quoted significantly above where Western futures were trading. Think about that for a moment. The paper market says one thing. The physical market is already saying another. When those two worlds reconnect, price discovery has a way of accelerating. And this ties directly into a theme I've been discussing for months, the growing disconnect between physical reality and paper representation. We are now several consecutive years into a structural supply shortfall in silver. Global mine output sits around 800 million ounces annually, yet forward projections suggest demand could outstrip supply by hundreds of millions of ounces in the coming cycle. That's not a rounding error. That's a systemic imbalance. For years, the gap has been bridged through financial engineering, leasing, forward contracts, rehypothecation, mechanisms that allow the same metal to serve multiple claims. But those tools depend on trust and liquidity. When either one tightens, the system feels it. And beneath the surface, tensions between major financial players and industrial demand centers have only added to the strain. Large withdrawals of deliverable silver from official categories into less accessible classifications have already reduced what's truly available when delivery is requested. In at least one recent instance, a participant seeking physical settlement found that the metal simply wasn't there. That kind of moment changes behavior. Short positions suddenly need covering, supply chains scramble, spot buying intensifies, and once supply gets locked up upstream, even at slightly higher prices, it can leave others chasing what's left. We've seen producers offered premiums well above prevailing prices just to secure material that had already been spoken for. That's not a normal condition. That's competition for scarcity. Meanwhile, investment vehicles tied to silver have at times traded far above the value of the metal they supposedly represent, a sign that demand is spilling beyond traditional channels. When regulators intervene to cool speculative excess, markets often wobble, But what's notable this time is that physical demand appears strong enough to absorb shocks that might once have broken momentum. Now, to stay grounded, there are counterforces at work too. Currency strength can create headwinds for dollar-priced commodities. Rapid price rises often invite short-term profit-taking, and supply projections don't always unfold exactly as forecast. These are real considerations. But what forecasts often miss is stress inside the lending and leasing networks that quietly lubricate the market. At one point recently, borrowing costs for silver spiked sharply when institutions that typically lend to one another stepped back. When private channels freeze and public borrowing becomes necessary, it's a sign that the informal cushion is thinning. Markets don't usually announce that loudly, but they show it in subtle ways. Now layer all of that into the near-term timeline. A major physical marketplace is about to reopen. Delivery obligations remain large. The shift into future contracts is lagging, and no fresh metal has entered the ready pool. At the same time, prices have already rebounded significantly from recent lows, moving from the low 70s into the mid-80s in a short span. What's fascinating is how sentiment swung during that move. On the way down, pessimism spread quickly. On the way back up, optimism returned just as fast. That emotional whiplash is common, and it often says more about psychology than fundamentals. Decades ago, policymakers understood that large futures markets could amplify volatility, overshadow physical trade, and shape public perception. Flooding the system with paper supply can exaggerate downturns and nudge investors toward short-term thinking. Fear does the rest. You don't have to force people to sell if they become convinced decline is inevitable. Yet price structure often tells a steadier story than headlines. Support zones hold, patterns form, momentum shifts quietly before narratives catch up. We saw that recently when silver stabilized in the low 70s despite widespread negativity, only to rebound once the structural footing became clear. None of this guarantees a straight line higher from here. Markets rarely move that way. But it does highlight how quickly perception can detach from underlying reality. So as we head into the coming sessions, the focus isn't on hype or prediction. It's on observation. Watch how quickly positions roll forward. Watch whether new supply enters deliverable categories. Watch how physical premiums behave as global trading reconnects. Because the unresolved question is simple. Can existing supply comfortably meet delivery demand if participation rises? With obligations far exceeding readily available metal, the answer may not be quiet. And that's why this moment matters. The silver market was built to function at far lower price levels than where it now trades. Yet demand hasn't faded, and if anything, it's broadened. So the real signal isn't just price, it's whether physical availability keeps pace with financial promises. Stay focused on the data. Let structure guide your view. And always separate noise from what's actually happening beneath the surface.